You're listening to The Intellectual Investor, episode number 26, Beats and Misses, Seen and Unseen, written by Vitaliy Katzenelson and read by Elliot. To read this article online or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Beats and Misses, Seen and Unseen. Wall Street glorifies companies that beat quarterly estimates by arguing that the long term comprises a lot of short terms. But beating earnings estimates for a few consecutive quarters doesn't necessarily lead to long-term greatness. It assumes that significant changes to the business are visible in the reported numbers. This is likely what General Electric executives rationalized as they destroyed the company's protective shareholder moat and its respected corporate culture. Their short-term thinking focused on beating earnings on a quarterly basis, thereby ensuring seemingly endless analyst upgrades. Except, GE's short-term success that was seen by the market came at the expense of unseen damage to its moat, balance sheet, and corporate culture. Conversely, consider Apple reporting what analysts considered disappointing numbers for 8 sequential quarters leading up to 2007. That's like 3 lifetimes on Wall Street. During that time, Apple is pouring every ounce of its resources into R&D and coming up with the iPhone. It cannot hire the right engineers fast enough, and thus must pull in engineers who had been working on the Macintosh, then Apple's bread and butter, which results in delaying the introduction of a new computer by a few years. And this did happen. Did those negative short-term results subtract from the value of the company? Or were they instrumental in adding trillions of dollars of revenue to Apple? Quarterly misses and beats show only what is seen, but true investors are able to see the unseen. With the luxury of hindsight, I pick 2 examples, GE and Apple, that seem to prove that earnings misses are great and beats are bad. But they are neither. They are a part of the vocabulary of the semi-staged reality game show on business TV, which I choose not to participate in. Facebook, for example, was recently accused of using casino gaming psychology to get their users to keep coming back, to see if their posts or family pictures were liked. Quarterly beats and misses are not much different. They add casino excitement to investing and turn unsuspecting investors into gamblers. This doesn't mean that investors should completely ignore what happens in the short run, but quarterly earnings should always be looked at in the right context, the context of the long run. Long-term thinking should be deeply embedded in your stock analysis. A discounted cash flow, that is, DCF analysis model, forces you to value a company the way you'd value a private business, bringing cash flows that lie decades in the future into the present. But DCF analysis, though grounding, is a crude model that is most useful at the extremes of a company's valuation, when a company is wildly overvalued or undervalued. This is why it makes sense to estimate a company's value based on earnings multiples. In my process, I look at a company's expected earnings 3 to 5 years out and then discount it back, that is converted to today's dollars. This is the key. By looking at a company's earnings this far out, you muffle the noise of quarterly earnings, the "what have you done for me lately" hysteria, and focus on the future. Thank you for listening. This and other investment articles by Vitaliy Katzenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.